This week, the stock market made a big jump. And you as an investor know probably why, but we dive a little bit deeper in the why, but also what will that have of a kind of effect for investment, the investment growth for next year. Yeah. We're going to talk about sectors that will benefit from the effects of what happened or what not happened this week, but also
based on the first signals that they gave us.
But also sectors that will not benefit and some sectors that you should be really careful with.
Absolutely.
So what happened? The Fed and the ECB came together, or Powell and Lagarde, they spoke. No, they didn't. They spoke. What did they say? So the market went up. So they announced big movements,
no, they
big
didn't
changes.
Do anything there. They said everything stayed the same.
The market.
So that was the vlog. Thank you.
The market thinks that based on what they said and what they read, is that the interest rates will go down.
Yeah, the Fed for about 3 times, no?
3 times, the year after 4, and etc. etc. What's interesting about the press release that was made public before Lagarde spoke, and there was one sentence was taken out, and the sentence was in the previous one, that the inflation is too high and will stay for a too long period, and that's taken out. So also the ECB is from the opinion that the inflation is under control. Okay. So it's more, the market thinks that they have more signs that the Fed will lower interest rates. On the other hand, the economical situation, the economical data drivers in the European zone, they show that the ECB must act faster than the Fed. Yeah. But the ECB looked in the mirror and they know from themselves that they were too late. They were late and too late, I think, with starting to raise the interest rates. They followed the Fed, but they were much later. So they're also really cautious by doing next important steps.
Absolutely.
And they think, a lot of people think there will be the second one. A lot of people think ECB will be the first, and the Bank of England for sure will be the last one.
Will be the last one, yeah.
And also important, then we go to the sectors, that there is still a program in place at the ECB buy financial products, and the program is called, Martin?
The Pandemic Emergency Purchase Program.
Still in place,
Still in place, yeah. The pandemic is far gone.
Yeah.
Well, you have a flu pandemic now, a little bit in Holland. You can tell us about this. He was sick.
It's now planned that halfway 2024 they will stop. They will lower the buying of the financial products, and they will stop completely in the beginning of 2025. Correct, yeah. And that's of course is a little bit of pressure on the market because it's a stimulus package and that's going out. I don't know how big it is in total, how big the impact can be on the market. So ECB in fact they spoke, and the market made a huge jump.
Yeah, the markets already since end of October were going up. So I personally thought, okay, nothing much is going to happen because we have already seen 14-15%.
It's already in the price.
It's in the price, yeah. The market is considering that nothing will happen. Yeah. But you see, you can never be sure enough because the Fed always surprises you. And that's also one of the signs. Never fight the Fed because you will not win it.
Yeah. So
what do you want to say?
No, I want to go further on that. Never fight the Fed. So the market thinks and the Fed thinks also that the interest rates will go down. So I think it's better for an investor not to think no, they will increase the interest rates. Take that into consideration,
and also for next year, don't make for sure that it will go down.
And if the interest rates go down, which sectors will benefit from it? Yeah. Last week we spoke about the AI sector that will grow, and it's always good to be as an investor in a sector that grows because then you can make mistakes, you can buy stocks that are relatively performing less. Mm-hmm. But if the sector itself is growing, then you have much more chances. And also, so that's why we said, okay, we're going to look at this, what's now happening, but also what probably will happen with the low interest rates next year, which sectors will benefit from it. And what you saw is, for example, based on this announcement, the real estate sector made a big jump. Yeah. Why? Because it's highly financed. Almost, with the professional investors, 50-60% of their assets are financed, short term, and not on fixed rates, but variable rates. So when interest rates go down, their cost of their business is going down, so the profit will go up. Yeah. On the other side, they also pay out a lot of dividend in a lot of cases 80-90% of the profit. So a lot of people buy it for the dividend. If you have a dividend of 5% and the market rate is 6, it's less interesting to buy that underlying real estate product than when the interest rate is 1 and you have a dividend of 5. So from both sides, it's really interesting. You see it? What happened? Well, how big was the jump with this sector? How much? What's the percentage?
About 10%.
Yeah,
8%. Yeah.
10%. I think everybody understands it. It's like the oh yes factor, but I think benefit from it.
Yeah.
And the second one?
Second one is the bond sector, the global corporate bond sector. There was a lot of news about it at the beginning of this year because 2022 was the worst year for bonds in the market. Bond prices dropped a lot because of the yields going up of the bonds. And it can only happen if the price goes down because you have an interest which you divide by the price of the bond. Yeah, the lower that is, the more interest you receive and you buy that thing. So it's a pretty simple explanation. Now we see the opposite happening. And we saw the iShares Global Corporate Bond ETF going up almost 3.5%. And that is interesting because you normally buy an ETF like this only for that sort of yield, 3-4%. You don't think about it. And now you had it in only 2-3 days. So yeah, you see the bond market is reacting
relatively
positively.
really hard.
Yeah, absolutely. And so that is, and we don't know where it's going to stop. It's only just the beginning, maybe.
Yes.
Only the first signals.
So those two will almost for sure will benefit from low interest rates. Which sector will not benefit, Martin?
And it's not really a clear explanation. They're also not suffering from it themselves. I think the business is behind it, but it's the consumer staples sector. And the consumer staples sector is the Nestle, it's Walmart, it's Coca-Cola, Heineken, those companies. Yeah, well,
I say it on purpose.
those companies in general don't have a lot of debt. They have a business and it keeps going on. It's the companies that keep selling. People keep going to Walmart. People keep buying Coca-Cola, etc. So they don't suffer too much from high interest rates. And what you see is when interest rates go down, then money from those sectors moves automatically to the more growing sectors like technology, etc.
There's a bigger chance that it will go up.
Maybe to real estate.
Definitely. Yeah. And you see it also. So the whole market went up, but this sector went down
almost 2%.
Yeah, and it's down 2%. Is not that much, but if it's against the market,
against the trend,
that says something.
Absolutely.
So be careful with that. And the last sector is the banking sector. What did the bank sector do this week? It also went up. So if you compare those 4 charts and you think, 1, 2, 3 and 4 are the same. I think you should be careful with the banking sector. This can be a false signal because banks are doing well at the moment because if you have some money on your interest you get on your saving account, you can maybe 1%. But if you have a new mortgage, you have to pay like 5%. And of course you have long money, that's long debts, short. But high over, the margin between the interest rates, what they pay for the 2 clients and what they ask if you need to borrow money is big. And that means the banks have a lot of margin. And if the interest rates go down, what they can ask for an interest rate for a mortgage will drop, but they can't offer a lot more on the saving account. There's much more less margin. So they will, from a P&L side, they will have challenges.
Absolutely.
But
yeah, there's also counter signals. I mean, Bank of America. There was I talked about it a couple of weeks ago, and the price of Bank of America was going down, and we were always like, why is it possible? Because they make more money on the money. Yeah. But they have bought a lot of long-term loans from the U.S. government, and they bought them at quite high prices, and they're long-term debt, and they have decreased, of course, in value. Now, the opposite is happening. Those bond prices are going up again, so they don't have such large unrealized losses on their balance anymore, or slightly less. And you saw Bank of America going from 28 to almost 35, 36 again.
Yeah, so from a risk balance perspective, they're doing better.
From a business perspective, they maybe not make more money, but they at least don't have the risk element weighing so heavy in their stock price.
Yeah. So be careful with that sector, because then you have to look at individual banks, but it is really difficult.
Exactly.
So to conclude. Funny movements based on nothing, only on outlook.
Outlook. And maybe outlook changes again.
But
so be careful.
But use that information. Don't fight the Fed. What you said. the marketing interest rates will go down. They probably will go down. Which sectors will benefit? There are more sectors, but real estate and the bond sector there are two sectors that will benefit.
Yeah.
The companies that are a little bit boring and don't use a lot of debt, they will probably don't gain as much as the other sectors. And the banking sector, yeah, be careful. So I think a little bit another angle, looking at the Fed and the ECB meeting as other vloggers do.
Exactly.
I hope it gave you some input for your investments.
Thank you for watching, and we'll see you next week.
Give us your time. Thank you. Bye-bye.